looking for the best fund to invest in. Is the best the right one? Well, we'll soon find out from this discussion that we will be having in Investors Hangout today with Dhirendra Kumar. Dhirendra, we welcome you.
Thank you.
This program is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. And I go back and ask Dhirendra, what is best and what is right? How would you define it?
Oh, it's, it always starts, you go to a social gathering, meet people socially, and, sometimes you meet a stranger at the airport, and he's just give me those 2-3 things, 2-3 funds, 1 or 2 funds, the best funds, because I must be knowing, and he's not, and he may not know about it. And that is the wrong starting point. The best fund is the only best fund is the one which is the most appropriate for you. And the appropriateness of a fund varies, dramatically. Your money for a few days, money for a few months, money for a critical goal. How much time do you have? And, add to it where the investor comes from. How critical is that money? What is the scale of investment? That also, has a bearing on your risk tolerance. So if you are barely able to save 2,500 rupees a month, your risk tolerance will be different. Even if you are investing, if you have a time frame of 10-15 years, because you'll be watching it closely. So how to start? So appropriate fund, I think, is a more crucial point. That is a great starting point. Okay. And given these variables, that what is your time frame? Where do you come from? How much experience do you have of, investing in a market-linked investment which go up and down so dramatically? That makes every investor's orientation or every investor unique.
Okay. And I like the term that you're using, investor unique. How am I unique from others? How do you figure out? Okay, you said that you meet a lot of people at airports and all that.
Airport social gathering,
अच्छे funds कौन से हैं?
सबसे बढ़िया वाला fund बताओ, और तुम्हें पता होगा. But that is what actually makes everybody unique. It actually there is nothing called an average investor, because the average investor, you can bucket them in some form or the other. That people who are looking at investing to derive income from it, old people. Right. Or people who have long years to invest, people who don't have many years to invest but they are still earning. So there are formative years, the initial years when you actually save little bit, your earning is not very, very high, and most of the money is consumed or spent. And then you get into a phase where you have reasonable surplus, you can invest but you don't have enough time. And then you get into a phase where you have, so that is the first level of, classification. Of course, nothing starts till you have surplus. Investing can't happen if you don't save. So first is, saving, then saving a little, then saving regularly. But what makes every investor unique from 2 points of view. One is that how critical is that money? If that 2,500 rupees a month which you are saving, and on that some critical life goal will depend, your child's education, your ability to buy a home, and of course 2,500 is the starting point. With rising, with gradually rising income, you might be able to save more over time. How to go about doing that? How will you withstand if you are going to be a first time investor? Your tolerance of risk, a decline of 10% of your investment value might be devastating. But somebody who has been in the market for 5 years and has been doing it, he might get used to it. He may have gotten used to it or acclimatized himself to that. Okay, it happens, but still it generates superior return over a period of time. So experience and how critical that money is, because there are investors, if you have plenty of, if you have accumulated meaningfully, and your investment goes, and the scale itself has grown, few lakh rupees, 50 lakh, 100, a crore or something, and then the investment moves up and down by 5 lakh rupees in a day, you don't bother, you don't care, because you have seen it through and you understand that how it works. But your first 50,000 rupee, if it becomes 45,000 rupee, your reaction will be very different. It will be very unusual. It looked like, many people I have come across who relate that in one day they lost as much money as they would have earned in another 3 months or 4 months or 6 months, or their investment value has gone down in 2008, where it would have taken 4 years for them to earn that much money. So the reaction is very understandable. So experience and how critical that money is makes every investor unique. And any investment course that you take should be very sensitive to that, because without that, because investment is not something which you take an action and sleep over it. It has a bearing on you on a day-to-day basis. You react, you look at the value, you start relating to real life things, and you get unsure of it, or you feel very happy. Sometimes you get very greedy that, oh, I wish I had not spent that money and invested, it would have gone so much more. So that greed and fear and the noisy market, which actually causes this greed and fear more fear than greed initially, is very important. So getting used to it, so devising a plan whereby you get used to it, because most investors are driven out of the market when they are not sensitive to this particular dimension, and it's understandable. So they need some hand holding, or they need to do their own homework to benefit from this.
Okay, so the risk-taking appetite,
the tolerance and experience. Yes.
The risk-taking appetite, the tolerance towards it, and if all this is there, okay, and somebody comes to me and says that, okay, X fund is pretty good to invest in, and I have over a period of time invested the money, as you said, risk and experience is there. Yet, if I want to go towards that, fruit-bearing fund which is hanging there, and they're saying, don't, wait.
No.
Should I wait?
No. Everybody should start investing. If you have been waiting, I don't think there is a point in waiting. You just have to decide on the course of, the course that you have to take. Waiting will not help you achieve anything. Effectively, your money goes down in value because inflation is always there. You don't see it on a day-to-day basis. Money lying idle is actually an opportunity loss. So you should invest. How to go about doing it? I think, I can give some broad guideline, though they are not exhaustive, which is, if you have never invested in the market and it's a very critical money, and it's a small amount of money, broadly you have to decide that whether it is for short term or long term. Short term money, don't take chances. Start with a recurring deposit if you don't understand investment for short term investments, 2, 3 years, 4 years, and critical goal. Else, go for a short term bond fund and do your SIP there. It will generate more return than a fixed deposit. It will be more tax efficient. It will also be liquid just in case you need the money a little early. And long-term money, I think it requires a real roadmap, because long-term is not visible. We always tend to procrastinate. We always tend to avoid that. Okay, we'll start it sometime when we have the money. Start it as soon as possible. Take the right course. If you are that investor who has no experience investing for the first time, maybe start with a balanced fund or start with a hybrid equity fund. They are relatively conservative. They will not witness a massive blow. They will not decline in values that dramatically as equity funds do. More importantly, what not to do for those investors. Okay. Don't purchase recent past performance. Don't look at that small cap fund and start investing in it. Because that is what I witnessed, that what happened, 2017 was a year when small caps went up by 50, 60, 70%. There were funds which went up by 80, 90%. And people looked at that tally, they looked at that charts, and they started investing. And 2018 has turned out to be extremely disappointing. It went down in value by 20, 30%. And that is where, you are scared, you discontinue, you are not able to develop a belief. So don't chase recent past performance. Choosing the right fund, right kind of fund is crucial. For somebody who has tried out, what the person you were describing, who has experienced the market, understands, he still has time, long-term investment, should get started with his multi-cap fund. That should be the mainstay. Because the problem which I face, with most people is that everybody is dominantly a fixed income investor. Most of their money goes into their employee provident fund or a public provident fund. Then they have their fixed deposit of large amounts. And then they start doing 8,000 rupees SIP, which will be a very insignificant part. It will be 5% of their total financial net worth. And they get completely sucked into it. They start worrying about it. They think that it's a game. No. Unless you put money at work, which will grow better, in a measured way, in a manner which you have a course that you have taken and you understand it. So for that person, it should be that multi-cap fund, one or two or three. Most of these plans, it is important for investors to keep it very simple. You should invest in one or two or three funds, choose the appropriate vehicle, be regular with it. Then comes an investor who has need for income. Choosing the right vehicle is one thing. Having the right expectation and having a withdrawal rate which is sustainable, which will make sure that you don't eat into your capital. Being conservative with it and allowing it time to fructify and then revise your income, because those investors, their needs are very critical and their mental framework is a little shaky, because the moment you stop earning, you are less, your anxiety level goes up, you are more unsure, or your little decline and you get upset. So being conservative with that investment and how to invest that money, because many a times investors invest at one go. So the same rule, back to basics, which is few funds, never invest at one go. Even if you have lump sum money, have reasonable expectation, have a withdrawal rate, understand a little bit before you invest, and depending on your experience, choose the appropriate vehicle.
So if somebody has a FD of say 30 lakhs, over a period of time, like we have a lot of people who take premature retirement and all.
That
and
I
now
think is
if
the
they're
default.
listening to and watching our program, what would you advise them? 30 lakhs are lying in their FD.
A lot of investors don't buy into it, but I have to tell them that you are on your way to poverty, because if you have all your money in deposits, it will be safe, but over a period of time you will get poor, because the interest that you'll earn on FD will keep coming down as inflation is coming down. Your need for income will keep rising despite the low inflation. The inflation is still
and
there.
No tax benefit.
And no tax benefit. So 30% of that will go towards, depending on your income, overall income. It can 30% of your income, interest income can well be taxable, can go towards taxes. So you will be left with, assuming that you earn 7% and 2% of that goes towards taxes, that 5% will just not be enough and your capital remains constant. So you need to take measured risk. Measured risk is the key word. Not inordinate risk, not try and maximize your return. Having a moderate expectation, beating inflation, ensuring that your capital will also go up and it will keep getting revised as your capital grows, and not consuming all the returns that your investments generate. So those things are very important, and understanding how it works, why it works that way, because no advisor will have as much time. You will come across many good advisors who will give you the appropriate ones, but you have to buy into the idea. You have to really understand that when things are not, things don't look good, or they're not promising, or it's disappointing, unless you understand, you won't have the belief to stick to that plan. You will act in a huff, you will act in a panic, you will panic. So that is something which is critical.
So in nutshell, if you were to tell our viewers, what investment to figure out, in which investment that they should go in for, then what are the few steps that they need to keep in mind?
No experience, go for equity income fund and balance fund.
Okay.
And do your SIP only. Okay. I'm referring to all this for long-term investment. Okay. Long-term investment defined as 5 years and more. Some experience, not extremely critical money, go for your multi-cap fund and invest to the hilt. Try and invest. Even tax-saving funds are multi-cap funds. Yeah. So first exhaust your 1.5 lakh rupees ATC in those tax-saving fund, or to the extent needed, and then go for the multi-cap fund. Investing for income, choose, and even if you have 30 lakh, 40 lakh, you decide to take your money from the fixed deposit, don't invest all that money tomorrow.
Not lump sum, but get into SIP.
Do a STP, put that money in an ultra short-term bond fund. Move that money over the next 12 to 18 months or maybe 2 years. Because you need that money, you will be withdrawing that money, or your need for that income from that investment will last for 20, 30, 40 years till you're alive. So spreading this investment and averaging your investments, eliminating the risk of catching a market high is critical at that stage. So do that, and then mount a withdrawal plan. and the money which you need for your consumption, that is our other alternative which you should be conscious of. Maybe you invest in a balanced fund, you invest in an equity income fund, depending on how conservative or aggressive you are, or your experience. So both these things into keeping that in mind. But after that, make sure that you are your withdrawal rate is moderate. It is not exceeding 6%, and as your investment performs, your 6% withdrawal rate itself, 6%, 5%, 4% itself will be higher, because if your capital grows, those 6% of larger capital, the appreciated capital, will ensure that you are having an inflation adjusted rising income even in your retirement.
So Dhiren very nicely have communicated to you as to how the best fund may not be the right fund. So please follow his advice and move towards prosperity. And it's time for us.
The critical thing is that everybody thinks that there is a trick, and the experts know it, and they don't know it. So getting that tip, getting that trick, no, you shouldn't follow a tip. You should just follow a method, and a method which will, because investing isn't a one-off thing. It is not that you have to do well over the next 1 year, 3 months, 6 months. This is going to have a lifetime impact, and it will ensure your financial security. So you need to follow that method, understand it. A tip will be, I'll give you a tip that which I think is a fund or a stock which will do well. I may be wrong. I may go wrong. Or markets may not behave. Everybody is focused on return, but I think focused on what you expect, what works over time, how to go about doing it is more important than looking for that best fund.
And understand your risks.
There isn't a best fund, is another thing. I can tell you after running value research for 30 years that it is impossible to predict which will be the best fund. I haven't succeeded so far.
So very well said. There isn't a best fund, huh?
There is.
Till today.
We don't know how to find one. You only know it with hindsight, So
okay. So the first question is from Ramesh. How are mutual funds different from shares? How do we manage them?
Mutual funds, the equity mutual funds are a collection of shares, and you entrust your money to a person who will buy shares and sell shares, and the gains, less expenses, come back to you in proportion to your investment, and it is visible on a day-to-day basis. So stock prices go up and down. That is how, and that is reflected in the NAV of a mutual fund for all the days when markets open. So this is how they are different. When you invest in a mutual fund, you are buying a collection of shares. When you invest in a share, you buy a company's ownership.
That particular share only. And how do they, since he's asked the basic question, I'm taking it forward as to how people make money in mutual funds.
They invest and they wait for it to go up. And
as simple as that.
As simple as that. And
but that happens in shares as well.
That happens in shares as well. But most of the time when people just get excited about shares or mutual funds because they have gone up very dramatically in recent past, soon after you buy, they go down. And that is quite disappointing. So that is why you need to be methodical about it. Then the way you have different kind of shares, there are different kind of mutual funds as well. There are shares of different sectors. When you buy a Tata Steel, or when you buy a Infosys, or when you buy a TCS, or when you buy a Mahindra and Mahindra, you know what you buy, an automobile company based on the prospects. Then there could be large companies, small companies, mid-sized companies. Then there are funds which specialize in those. There are funds which invest only in large companies. There are funds which specialize only in mid-sized or small-sized. Then there are funds which specialize in investing in a certain sector. You should keep it simple. Most investors should do it, keep it simple. They should buy a multi-cap fund which provides an opportunity to the fund manager to invest all across the market. The real understanding which investors take a lot of time to understand once they move, because most investors start as a game where quick money is to be made and you need the tip. It isn't like that. When you're buying shares, you actually become a part owner of that company, and you are liable for, you will get all the benefits of that ownership. The company makes profits, company makes higher earnings, you benefit on that. Mutual funds, you get it for the aggregate of the set of companies which the fund manager has bought it. So I would say that understand these basics and get started now.
And if you want, you can go back to the program, in the sense this particular program only, where he explained if you're an initial investor or if you're a matured investor, what you should be investing in. The next question is from Tanmay. I have an investment experience of around 2 years. Would it be wise to start investing in sectoral funds? Also, is it fine to invest in a fund with exposure to foreign securities?
I don't think, for most investors, sector funds make sense. Sector funds don't make sense because the whole idea of investing in a mutual fund is that you are getting a diversified, you are able to diversify quickly and you are getting exposure to different sectors while investing in a fund. And if the fund manager decides that, there is a sector which needs to be emphasized, he should have more of that sector in his fund, he does that. If there is a need to avoid a sector in a fund, he does that. A sector fund will not do that. When you buy a sector fund, that fund manager is supposed to invest in all, that sector only. And when he invests in that sector only, all sectors are cyclical. They do well sometime, they don't do well sometime. So the onus is on you. You have to be responsible for getting in the sector and getting out of that sector. And it's very difficult to predict the cyclicality of it. When everybody thought that pharma funds only do well, they have been the worst performing fund category for a while, and after doing so well for 10 years. Likewise. So things turn around when you least expect it, and that is why you diversify. Your second question, that is it good to invest in a fund which also invests abroad? Yes, it's a good idea. You get greater diversification. You also get great companies to invest in which is not necessarily based in India. If you want to invest abroad yourself, it is difficult, it is complicated. Of course, every Indian is allowed to invest up to $200,000 equivalent annually per person abroad. You can do that. But it's complicated. You have to open an account with a foreign brokerage as well, place the order, choose the company, or buy a fund. Domestic funds provide you that mechanism. There are many funds which invest 15, 20, up to 35%. And there are foreign funds as well. You have plenty of US domiciled funds. So a small part of your money can go into
RBI clearance required.
Nothing needed. You invest, they are domiciled in India, they are sold by Indian fund companies. You can buy a NASDAQ fund, or you can buy a US opportunity fund, or you can invest in many funds which invest a small part of the money abroad.
How does the fund size impact investors in case of mid and small cap funds? This is a question that has come from Satish.
It impacts negatively if the fund gets very big. And the reason is that a small cap fund has to invest in small companies. And small companies face liquidity issue. If you want to buy 50,000 shares of a company, it could be fine. But if you have to buy 5 lakh shares of a company, it may be very difficult to buy. And then the other side of it, when you want to sell 5 lakh shares of a small company, the price will crumble. So you have to do it in a fairly measured way. Buying and selling large quantities of small companies is difficult. And if you are unable to do that, and when you, assuming that you are running a fund manager, a small cap manager is running a 300 crore fund, and he wants to invest in 30 companies. So he has to invest 3 crore in each of those companies, which is fine, which is possible. He'll be able to do that. The moment it becomes 3,000 crore, either he has to look for so many more ideas, or he has to invest a large amount in those companies. So it's not possible to do that. Running a small cap fund, running a mid cap fund, of course the definition of mid cap has been liberalized a bit, so that many of the mid cap funds are actually large companies with reasonable liquidity. So mid caps are managing it well. They can well be larger funds, but small caps, I still feel that as it gets very large, it gets difficult to manage. Fund manager has to look for more ideas, and they lack maneuverability. Because assuming that it becomes a 3,000 crore fund and you have one position which can't exceed 30, 40, 50 crore, then you have to, and even if you are able to find a company which multiplies in value by substantial, by 2-3 times in 5 years time, the net impact on the fund is not as much, because the allocation to that particular stock which has done exceptionally well will be very insignificant. So size is a barrier to small caps.
Okay. And in the has written asking how can I decide whether to opt for a direct plan or a regular one?
It entirely depends. If you need hand holding, go to an advisor, go to a mutual fund agent, and you will be given the regular plan. If you don't need the hand holding, if you can do the online investment yourself, if you can choose and stay on course with your investment plan, go for the direct plan. They are less expensive. They make little more money than a regular plan.
And you don't have to give any money.
Yeah, they are not. You don't have to pay money in either case. But the direct plan expenses are lower than the regular plan, which end up generating little more return for you over time.
Chandramouli has written, I'm looking forward to make some lump sum investment in mutual funds. For how much fall in the NAV should I wait for? He wants to time the market.
Yes, I don't have advice for you, because there is a possibility that if you wait for the fall, you will keep waiting. And there's a possibility that there's a high likelihood that you will keep waiting forever, because and then you will behave in a fairly unreasonable manner, because once you see that your waiting has not worked out and the investment has gone up by 25%, the market has gone up by 25% or 20%, and in a very surprising way, while you are waiting for the markets to fall, then you will behave in an unusual way. Devise a mechanism, devise a system that irrespective of anything, you will put 10% of your money on the last day of the month if the fall does not materialize. Try and time it for your own satisfaction. But you will invest 10% or 20% of your money, come what may, by end of the month if the fall does not materialize, so that you are not left out of the market. Markets behave, predicting these falls and waiting for it has not worked out in the past. So most fund managers are unable to do it.
Okay, how important it is for an investor to go through this entire cycle, the cyclical aspect of
that is inevitable. You can't. You can't avoid it. That is the nature. That is the design of it.
Mm-hmm. Okay, is it advisable to invest in NPS at the age of 52? I'm already investing in mutual funds, asks Rudra.
NPS has improved, but for somebody who is at 52, in fact, NPS has also been liberalized. You can well keep investing till about 70 if you are still working and if you have income. But if you are investing in mutual fund, you can well do without it, because NPS will lock your 40% of your accumulation. Going by his age, you still have 8 years to invest. 40% of all your accumulation will be locked. 60% you can take out as a fair, in a very convenient way, entirely till 60 all your accumulation, and then you can take 60% of it. Okay. You don't have to necessarily withdraw it. It can still lie there. But when you want to, 40% of the money will be converted into annuity, and 60% you can take out. 60% you can take out, which is better than mutual fund, which is completely tax-free. Also, NPS was allowed to invest only up to 50% maximum in equity. Okay. Now that maximum in allocation to equity has been increased to 75%. So NPS has improved. It has also, but that 40% lock-in in annuity, which may not be the wisest thing. So you can well carry on, for simplicity, your investments in mutual fund.
RB Singh writes in saying that I have been investing both in mutual funds and direct equity shares, but have lately realized that I am more comfortable with mutual funds. I have accumulated a corpus of around 35 lakhs in direct stocks. Should I
hand it over to
PMS or gradually shift to mutual funds?
Shift to mutual fund. I generally avoid PMS for investors like you, simply because it's more tax efficient. When you invest in a PMS, all the short-term gains generated, short-term gains meaning the PMS manager, portfolio manager, he will be doing the transactions, and any sell before 1 year will be liable for 15% capital, short-term capital gains tax. So that is your liability. So in the PMS is nothing but giving a power of attorney to an individual to act on your behalf, and every transaction will be considered as yours. In case of mutual fund, what happens is you give your money to a fund manager, you buy the mutual fund units, and whatever be the fund manager's activity, it doesn't matter. Till you hold your investment for 1 year and more, it is treated as long term. That apart, I think mutual funds are more intensely regulated. Mutual fund managers are supposed to disclose the NAV every month, disclose the full portfolio every month. If they don't do well, they run the risk of investors pulling their money out. They are very transparent. If they go wrong with any of these compliance, then the regulator will actually take them to task. PMS is a loose arrangement between you. They are regulated, but you are supposed to, it is an understanding between. And also, when you look at the performance claims of a PMS, you don't know, because every PMS performance of every investor is unique to him. It is not supposed to be known publicly. In case of mutual fund, you can come to Value Research, compare, look at their portfolio, see how they have done in a down market, how they have done in an up market, how is the fund manager, how long he has been around. You can do things with your eyes and ears open in a more transparent manner. So go for a fund.
Dhiren, thank you so much for taking care of our viewers' questions and answering them so beautifully. Thank you. Well, that's all we have in today's program. Till we meet next time, keep investing. Bye for now.